In this week's video, we'll review the latest charts to help us assess the odds related to new highs before year-end or serious post-election disappointment. As we walk through the charts this week, keep the following question in mind. Do the present-day charts align with or contradict everything that we've been covering since early April of this year? It's a monthly chart of the NYSE Composite Stock Index. This is the 50-month moving average in blue. You can see typically when really bad things happen, a lot of that price action occurs below the 50-month moving average. During strong long-term or secular trends, price action tends to occur above an upward sloping 50-month moving average. If we look at this blue shaded area here and this blue shaded area here, it's possible for the relatively early stages of a trend to morph into a longer term bullish trend. It's also quite possible for it to roll over in a violent manner. So what we're trying to discern is, based on the evidence that we have in hand today, what are the odds that this chart in the present day stays above an upward sloping 50-month moving average? What are the odds that it reverses and morphs back into something like this? It's also important to keep in mind, notice we have revisited the upward sloping 50-month moving average and recently dropped below it. You can see we have something similar happen here. We have a big plunge here in 1987. Here's a big plunge. This plunge does look weaker. However, after this plunge, good things happen for a long period of time. Let's look at the moving average in isolation to see what we can learn. We know that harder markets are often followed by easier markets. Harder markets are often followed by easier markets. It's been approximately 6 years since the moving average broke out of the top of the orange box and exceeded this high. A similar look started right here when we exceeded this high. So you can make an argument we could be in this area here, or that this box here is similar to the present day box here. It's pretty easy to make the argument that this period here of sideways action looks different than this period here, and this period here of indecisiveness looks different than the present day period. How is it possible, within the realm of possibility, that we could see something like this walking forward? Well, there are obviously numerous factors that would contribute to the answer to that question. One of them, and an incredibly important factor, is a major shift in Fed policy. It's also noteworthy that central banks are starting to talk about the possibility of adopting digital currencies in the future. This is the Bitcoin Trust ETF GBTC relative to the equal weight S&P 500. Long-term period of consolidation following this relative plunge here, trying to break out of this box in a bullish manner. We'll see what happens. The Fed's new inflation policy helps us keep an open mind about better than expected outcomes. But we know we want to remain open to all outcomes, from wildly bullish to wildly bearish. This topic here helps us with the bearish end of the spectrum. A couple of tweets here from Ned Davis Research. Here's the Twitter handle. Biden is proposing a 39.6% capital gains rate, which would push it to near record territory. That's the bad news for investors from a tax perspective, but as shown on the right side of the screen, there's really not a strong correlation between raising the long-term capital gains rate and S&P 500 performance. Sometimes good things happen, sometimes bad things happen. Now we're going to take a broader look at the weight of the evidence relative to assessing the probability of this chart moving in this direction, or this direction. This is a monthly chart of AGG, which is a diversified basket of bonds, relative to SPY, which is a diversified basket of stocks. We can think of this as risk off relative to risk on, or fear relative to confidence. And if you want to know what increasing fear looks like, a good place to start is the financial crisis. Let's take this portion of the chart here and add in the S&P 500 index on the bottom for reference purposes. Before we look at the same ratio in the present day, it might be helpful to look at the ratio the Friday before Lehman filed for bankruptcy. That would be Friday, September 12th, 2008. Lehman filed for bankruptcy on September 15th. So here's the look of the ratio on September 12th. So this is this same chart here. We're just looking at it in a different form. It's noteworthy that the ratio made a low 16 months prior to Friday, September 12th, 2008. And before Lehman declared bankruptcy, the ratio was making a new 16-month high. This low was made before the stock market peaked in 2007, telling us that fear started to increase well before the stock market peak and well before the black swan event of the Lehman collapse. When we're looking at the ratio of bonds to stocks, this is what increasing fear looks like. Price near a new high. Price above the 50-month moving average. The slope of the 50-month moving average. Trying to turn up. The ratio has been making a series of higher highs and higher lows. This is what an uptrend looks like. This is what an uptrend looks like in increasing fear. Now let's take this portion of the ratio here and look at it on a longer term chart so we can compare this look and these bullet points to the look of the same chart in the present day to see what we can learn. This chart is dated October 22nd, 2020 at 1:50 p.m. Eastern Time. Noteworthy, we're looking at a lot of monthly charts here. These charts don't go into the history books until the end of October. Now let's blow up this portion of the chart and zoom in and see how the present day compares to this period here. When fear is increasing, price is near a new high. Right now, price or the ratio is near a new low. When fear is increasing, price tends to be above the moving average. Price is not above, price is below. When fear is increasing, the 50-month moving average tends to turn up, and that's when longer-term fear is increasing. We don't have any kind of turn-up look here. In fact, if anything, the slope of this line looks like it's about to turn down. In the financial crisis case, we're making a series of higher highs and higher lows. In recent months, we've been making a series of lower highs and lower lows. This is what increasing economic fear looks like. This is what decreasing economic fear looks like. Thus, it's probably fair to say the look of the chart in the present day really doesn't check any of these boxes. In fact, the look is almost a polar opposite. And these statements are being made based on the chart in front of us. We're not making any assumptions about what this chart is going to look like in 3 hours, 3 days, 3 weeks, 3 months, or 3 years. But right now, this chart doesn't look anything like this look here. Sticking with the same ratio, AGG relative to SPY. We've talked about this before. Sometimes a short stay above a moving average. A short stay above a moving average provides a lot of information. After this short stay and decline, really good things happen in the S&P 500 for a long period of time. Here we have a breakout, a retest, and this is a successful retest because we push higher and make a higher high. Here we have a breakout, and now we have what looks like a failed breakout. This looks like a failed breakout. This and this look quite a bit different from this. Now let's take the same ratio and put a momentum indicator on the bottom of the chart. This is the True Strength Index. You can see here, this is where the S&P 500 peaks. Fear momentum is increasing. This is an increasing economic fear look. Near the low, March 9th, 2009 is when the S&P 500 bottoms. This is a decreasing economic fear look. Near the election in 2016, right in this period here, this is also a decreasing fear look. How does TSI look today? It looks like a duck head at the moment, but it's pretty fair to say that this look here really doesn't look anything like this look here. This is black moving from below to above. This is black moving from above to below. And it's also pretty easy to say that the present day look is a lot more like this rollover look here and this rollover look here relative to this increasing fear look here. None of this predicts the future. All of it simply speaks to the probability of good things happening relative to the probability of bad things happening. And it also helps us assess the odds of the present day chart moving in this direction, as it did when fear was increasing in 2008, or moving in this direction, as it did after the election in 2016. Now let's look at a similar chart of the S&P 500, keeping in mind this is the look of a strong trend, and this is the look of the early stages of a bearish episode. October 22nd, 2020, you can see price is well above an upward sloping 50-month moving average. The same concepts apply. Harder markets or periods of indecisiveness and consolidation are typically followed by easier markets. Once again, we can make an argument. It's possible that this plunge here in the relatively early stages of this secular trend is similar to this plunge here. You can see if we box them up after this, good things happen for a long period of time. And once again, we're not predicting anything. As we walk forward, the longer we stay above an upward sloping 50-month moving average, the higher the probability that something like this will happen. If we morph into a look like this, we learn something as well. Remember, we're trading the chart in front of us. How does the chart look today? Price is well above an upward sloping 50-month moving average. So you may be sitting at home and you may be saying, there is no possible way that something like this is going to happen in the present day. If we look backwards, stocks have been rising for 12 years. This can't go on. Yes, we could have said something very, very similar right here after the 1987 crash as we are pushing higher. There is no possible way that the stock market is going to rally into the spring of the year 2000 from the low in 1987. Thus, we can make an argument, once again, that this point here is similar to this point here. The only difference is, in this case, stocks have been rising for 12 years, and in this case, stocks have been rising for 13 years. Not trying to predict anything, but history tells us that it is possible for something like this to happen after a 12-year rally. And it is possible for something like this to happen after a period of long-term indecisiveness and consolidation, after a period of long-term indecisiveness and consolidation. Thus, just as it's very, very easy to say no way in the present day, it's been very, very easy to say the same thing near the low in 1987. And despite that, from the low in 1987 to the peak in the spring of 2000, the S&P 500 tacked on an additional 582%. That's this move from here to here. It does not include any of this 13-year move here. And since it's fair to say that the basic look of this chart in here is very, very similar to the basic look of this chart in here, it helps us keep an open mind about much better than expected outcomes. And if bad things happen and we continue to trade the chart in front of us, eventually we'll see this look here morph into something like this, this, or this. And if that happens, then we'll have new information. It may happen, but it hasn't happened yet. All right, earlier we spent quite a bit of time on AGG relative to SPY, bonds versus stocks. Let's look at similar concepts, except Now let's look at IEF relative to SPY. Here's the 2008 look. The present day really doesn't look anything like that. And the fact that we can't really check any of these boxes in October of 2020 is the good news. The bad news is, or the news that helps us keep an open mind about wildly bearish outcomes, is we don't have a bearish breakdown here yet. So this chart helps us assess, do we want to own bonds? When it moves in this direction, obviously that's a bullish trend for bonds. If we're trying to decide whether or not we want to own stocks relative to bonds, we just flip the ratio upside down. Here's SPY relative to IEF on October 22nd. This chart has work to do. This ratio failed here in Q1 of 2018. Really bad things happened in the stock market. It failed in Q4 of 2018. Really bad things happened until Christmas Eve of 2018. And in Q1 of 2020, we had the COVID plunge. This is the chart in front of us as of October 22nd. It helps us keep an open mind about worse than expected outcomes. And you can see SPY relative to IEF, or intermediate term treasury bonds, has somewhat of a flattish sideways look up here. The S&P 500 relative to TLT looks even worse. This is a downward sloping trend line. We're not even near that trend line in the present day. That's the bad news. The good news, it's really not unusual to see sideways action like this. However, this is sideways action. This is after the election in 2016. There's your bullish breakout. This really isn't sideways action at the moment. This is a downward sloping trend line with white space here. This chart had work to do, and this chart has work to do. But it's not unusual for this chart to have work to do under bullish circumstances. Remember, this is SPY relative to TLT. This is the same basic ratio using mutual funds going back to 1994. Here, the S&P 500 bottoms in October of 2011. This ratio doesn't experience a decisive breakout until early 2013. Here, the S&P 500 bottoms in February of 2016, where my cursor is. We don't get the definitive breakout until after the U.S. election in November of 2016. But in the present day, if good things are going to happen, we need to see something like this or this. That may happen. Hasn't happened yet. And as you can see here, it may happen in a relatively violent manner, telling us it's prudent to be prepared for a wide range of outcomes. Here's another plus in the present day. The look of the chart here is a breakout above an upward sloping 50-month moving average. This looks like somewhat of a retest, and now we're trying to print a higher high in October. That's to be determined, because this chart is not in the history books yet on October 22nd. However, this look here really doesn't look anything like this look here in 2000. Really doesn't look anything like this look here in 2007. And really doesn't look anything like this failed breakout above a downward sloping 50-month moving average in 2011. This is a breakout above an upward sloping 50-month moving average. It might be helpful to look at a similar chart with market leaders to help us assess the probability of this ratio moving in this direction. Now we're looking at QQQ, the NASDAQ 100 ETF relative to TLT. And you can see we already have the breakout. This is where the concerns start in 2018. Here's our COVID plunge. Not only have we broken above this downward sloping trend line, but we've made a higher high. This tells us to keep an open mind about better than expected outcomes. Similar situation here. Market leader, Home Builders, has exceeded this downward sloping trend line. QQQ relative to TLT has exceeded the downward sloping trend line, telling us to keep an open mind about TLT relative to SPY exceeding the downward sloping trend line. Still need to see it. This is the longer-term look of QQQ relative to TLT. This is a shorter-term look on a weekly chart. We would prefer to see a weekly close above this level here so we can make a higher high. This chart is dated October 22nd, 2020. Remember, keep in mind, the longer a market goes sideways, the bigger the move that we can expect to get if we get a bullish breakout. And we can draw a sideways horizontal line on this screen here going back to Q1 of 2018. That's 1, 2, almost 3 full years of sideways action. Similar situation, QQQ relative to GLD. We'll learn something either way. This is October 22nd. Is there anything else that can help us assess the odds of this chart staying above an upward sloping 50-month moving average? The answer is yes. The exact same concepts that we've been talking about on all the ratio charts apply to XLP, or defensive consumer staples, relative to SPY. This is your increasing economic fear look. All of those bullet points apply. How does the same chart look today? It really doesn't look anything like that. Slope is up, slope is down. Price is above an upward sloping moving average. Price is below. We're making a series of higher highs here. We just made a multi-month low in this chart here. This really doesn't look anything like this. Everything that we just said about the previous chart, for the most part, applies to this chart, except we've made a more significant new low on this chart. This is what increasing economic fear looks like. Present day really doesn't look anything like that. This is XLP relative to XLY. This breakout look here in yields also aligns with increasing economic confidence, dated October 22nd. High yield bonds relative to treasuries, October 22nd, above the June high here, trying to clear this consolidation box. This chart also aligns with the previous charts. Here's your COVID plunge here, small caps IWM relative to TLT, a discernible lower high. Momentum discernibly weak in here before really bad things happen in the stock market. How does the same chart look today? The answer is momentum looks much better, and instead of a discernible lower high, we have a discernible higher high, and this is a daily chart of IWM TLT. This chart does not predict the future. We're making statements based on the chart in front of us. If this breakout fails, we'll learn something. Back to SPY relative to TLT and the downward sloping trend line and the lack of a breakout. What can we learn about that chart if we look at SMH semiconductors relative to TLT? A discernible lower high in here, a discernible higher high in the present day, and we have exceeded the pre-COVID plunge look for the ratio. This is what increasing economic fear looks like. This is what the last few weeks look like. For the most part, everything that we said about the previous chart applies to SCHG relative to TLT. Maybe hearing a lot of talk about the demise of growth stocks. It is possible after a period of outperformance that they'll underperform, but it's hard to make the argument that TLT looks better than SCHG based on the look of this chart. This is a new high here, well above the pre-COVID high and well above the June high. This is what leadership looks like. Here's your June high here, here's price here. Compare that to lagging small caps. Growth relative to TLT is way up here. This chart's just trying to clear the June high. We can take these same concepts and use them on the chart of discretionary stocks relative to TLT. Here's a similar downward sloping trend line, similar to the downward sloping trend line that we have on the chart of SPY relative to TLT. Market leader XLY has already experienced a bullish breakout, somewhat of a retest look, and a higher high. It's a weekly chart dated October 22nd, 2020. Chart of the S&P 500 index, October 22nd, 2020. Trend strength model, healthy. This is a full bore bullish look. Price above all of the moving averages, and the slopes of all of the moving averages are up. The fastest moving averages on top. And the slowest moving average, the 200-day moving average, is on the bottom. We are trying to recapture a full-bore bullish look this week. 150-day moving average is trying to clear the 200-day moving average. This is what the end of a trend looks like. It's possible this is the early stages of a new trend. Look at the moving averages here. This is increasing fear. This transition is decreasing fear. Also noteworthy, this move from the March 23rd low to the recent high, this price action here has taken place well above the 38.2% retracement and well above the 50% retracement. Now back to the NYSE Composite Stock Index. In this case, we're looking at the chart dated October 21st. The longer price can stay above an upward sloping 50-month moving average, the higher the probability that something good could happen walking forward. Once again, it's incredibly important to emphasize all the statements made in this video are based on the chart that we have in front of us, the facts that we have in hand. We're not making any predictions, we're not forecasting anything, or making any assumptions about what this chart will look like in the future or any chart covered in this video. In their present form, these charts help us understand and assess the probability of good things happening. If these charts deteriorate in a meaningful way, they will also help us assess increasing bearish probabilities. And while it's very, very difficult to ever envision good things happening for a long period of time, and I can guarantee you it was very, very difficult at the 1987 low to envision something like this happening over the next 13 years. And you can make all of the bearish arguments that you want. What about this? What about that? If the bearish arguments are accurate, then all of these charts will deteriorate. So the answer to those questions is we have a way to handle that as long as we continue, keep an open mind about a wide range of outcomes, and to continually test and retest the bullish hypothesis with a flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.